Good afternoon. Hope everybody's having a good Saturday so far. We've got a rainy day on our hands here in Northeast Ohio. And I had a request to take a look at a video by Claybro. And some of you might remember, I did look at a couple of videos of his before on the other channel. And as I scroll down, I'll just kind of look at some of these titles. We have another confirmed short squeeze video out. Benji says, it's happening now, apes. Prepare for this. I mean, how many times has he cried wolf on that? It's happening now. It's happening. It's going to happen. It is happening. I mean, the reason AMC stock is ready for takeoff, the reason, and I can tell right now, he's looking at Reddit. So he found the reason on Reddit, and it looks like he's talking about Spider-Man. I guess we're back to using fundamentals as a squeeze catalyst. That's cool. Oh my God, stock will explode. Matthew Perry. Ooh. Just the beginning. AMC is going to the moon. We're going to get to this video here. It's here somewhere. Jackson Hunter. AMC up 19% today. And why? He says. AMC is on the verge. Here's Rico. Man, that is creepy. That is a creepy looking dude. Those eyes and that headband. I mean, he looks like a serial killer or something. Looks like that guy that has been getting in the beef with Ape Father. Okay, anyway. Claybro, could this rally lead to the squeeze? Let's find out. What do you have for us, Clay?
AMC stock absolutely rolling today. Guys, we crossed back above that $30 level, and I know, we were pretty low at $20 per share, but it is so nice to see the excitement, just the people buying and happy with AMC, rolling up above 20% gains in one day. Now, there's a lot of people out there wondering whether or not this could be the start of the short squeeze, whether or not this could be the start of another rally that takes us back up to above $72 per share, and so on. So we're going to discuss maybe some of the reasons we're seeing AMC stock moving like it is right now.
And then I'm going to give my thoughts on probably what I'm going to suppose is a more realistic explanation for some of these more volatile price moves, especially the upside moves, once we see what he says. And I'm going to speed him up a little bit because he's kind of a slow talker.
What's up, everybody? I'm Clay. I'm here to make 2021 the best year ever. If you haven't clicked the subscribe button, make sure to buy stocks. You can use the link in the description for Webull. It is super simple to set up your account, and a $100 deposit is going to get you
Webull promotional. I thought these guys hated payment for order flow.
AMC stock, man. AMC stock performing phenomenally over the last couple of days, touching $20 earlier on in the week, closing the week at $29 per share. Guys, up 50%. From the low to the high this week. Incredible to see these gains. And that brings a lot of excitement back to AMC stock. You know, even when we were at $50 and then we're down to $45, there's discouragement, disappointment, a lot of hate going on. But going from $20 to $30, even though we're below that $45 mark, people are happy, people are excited, people are wanting to get back into AMC. And this is a beautiful thing because this can bring in more people, more eyes. And when we get more people, more eyes, that could potentially lead to more buying pressure and more buying power. And therefore the stock price continues to rise. So a couple reasons why we may be seeing this. Number one, $20 was very low for AMC. Now, I know you're going to get price predictions out there that say AMC is going down to $6 per share and so on, but $20 was that low support level that we saw back at the beginning of June and back in January. Knowing that the stock price, knowing that AMC touched $20 per share, a lot of people, not just apes, but a lot of the technical traders went out there and started to buy AMC.
Okay, let's look at the chart. And we're going to have to go year to date on this. So, let's see. June, there was nothing. He said June, right? There's no 20 in June, was there?
Per share and so on. But $20 was that low support level that we saw back at the beginning of June and back in January.
Low support level we saw in the beginning of June? We'll see. I mean, $20 is right here. I mean, I'm not quabbling over, you know, that. But just, you know, as a matter of fact. So that's on 20. It looks like it left 20. So it looks like it almost hit 20 on May 26th. And then on the 27th, it blew through it and literally has not been back. Now, maybe he's talking just about the 20s. To me, there's a big difference between 2080 and, what did I say, 2853. And especially when 2853 was the low. You did see what here? We got 28.91 here. So I wonder if I put support and resistance on, if it's going to identify some of those levels. So it gives us 36 and 9 here on Fidelity. Now another thing we could do, and I'm going to do this on TradingView just because it's a little easier. And this might not be exactly on there. And I usually do go to the lowest and upper wicks. So there we go. Now you could go all the way back to January, and it's going to bring that lowest level down to 17. But I'm going to take it back to the 6th of May. So again, there's that 22.55 and 33.25, 40.76. That's the 50% retracement level. 48.27 and 57.57. So the stock mainly, once it got below the 48.27, pretty much stayed below. I mean, it's only up above it, 3 days, and then it popped back down. So you might say that the 48.27 level became sort of the main resistance level. So if you follow the price action, you popped up to 72, popped down to 57, hang out around 57 a little bit, jump down to 33.25 level, and that was a little bit of an overcorrection. So then it pops back up, and then it snakes its way down. It hits that 33 roughly level again, and then it comes up and hits this 48 level and bounces off of that, comes down, bounces off the 33 level again. This time catches the resistance at 40, that's that 50%, and then back down to your 33, and then back up to the 46, and then hanging out there a little bit. I'll let a vibration around that level, and then after that vibration you have this latest move to where it interacted with this 22.55 level. So Fibonacci retracement can be very useful. The levels don't have to be exact to still be meaningful and to give you a general idea of where these levels are, what may be likely to happen based on that pattern. So anyway, I'll accept 20 as the level because it could be anywhere from 17 to 22 based on what I just did. So far, it's all right.
Knowing that the stock price, knowing that AMC touched $20 per share, a lot of people, not just apes, but a lot of the technical traders went out there and started to buy AMC stock. So that's one of the reasons we may have started to see the run. Another potential reason, which I'm going to lean towards the first one, but another potential reason is that AMC's release of, well, it's not just specific to AMC, but the release of Spider-Man No Way Home is just destroying the box office right now. I believe it led to AMC's best day in the last 2 years, second best day in AMC's history, and so many people, 1.1 million people filling AMC theaters over just the last 24-hour period.
It doesn't have to be an either-or thing, first of all. Like he said, well, it could be that it hit this low level and it was on sale, and so a lot of people bought it. And then the second reason could be because, well, I'm leaning towards the first. Well, it can be both. There can be elements of both there. But to that point, let me get this off here, and let me do this. So we'll just do like maybe a month. We'll do the last month, and we're on 30 minutes chart now. Okay, so this is AMC. Now, let me add a comparison. Well, how about Cinemark? That's another theater chain. So what do we got? So I just zoomed in to the beginning of December. So you get December 1st over here on the left. So yeah, you have a very, very similar pattern. Very similar pattern. Not exact, but general contours following each other. So what does that tell you? Obviously, Cinemark is trading lower than it was last year, where AMC is trading higher than it was last year. And I think that can be explained by, well, AMC has got a lot of retail engagement, and that's holding the stock higher than its fundamental value. Whereas Cinemark is going to have less interest in it than AMC on a retail level. Maybe it's missing some of that, but certainly it doesn't have the level of retail engagement. And AMC has been aggressively trying to save itself from bankruptcy, whereas Cinemark was in a better position before the pandemic. So again, two different companies, but same industry, worth looking at. All right.
Going to see Spider-Man, it is incredible how much revenue is being generated by Spider-Man, and therefore increasing revenue, increases fundamentals, and increases the excitement around AMC, knowing that people are going back to the theaters. You're not going to see that. You're not going to see that in the mainstream media. They're going to tell you the theaters are dead. Streaming's going to beat them, and theaters are, dead in the water. But with 1.1 million people multiplied by the movie ticket prices, multiplied by the...
Well, I don't know about that. I saw an article about it last night. Here it is in Reuters. Here it is in Market Watch. Here's another Market Watch. So, I mean, it is being talked about in the media. I don't know where you got that from.
The concessions that they've spent. AMC made a lot of money this weekend, and that is great news across the board.
That does not mean that the company will be profitable. It does not mean that the company will be able to pay its debt. In other words, they have to do that consistently. And even that may not be enough to save them. Because at some point, you will have retail dollars exiting the stock. I mean, that's just inevitable. It's going to happen. But that's starting to get into the question of whether the company is really the point. I don't think it really is, because these apes are concerned about making a lot of money in a massive short squeeze. And I've said this before, I'll say it again. If there were to be a massive short squeeze, a Moass, on AMC stock, the effects on AMC, the company, would be devastating, especially with the number of shares that exist now. I think it's 5 times higher than it was last year. I mean, they've added massive amounts of shares, and still the price holds at 20, 25. That will deflate to an insane degree. So it's probably just a matter of time. This is a Band-Aid. It's a piece of Flex Seal tape that's put on the outside. It's not a permanent fix, especially when you have most retail apes, saying that they are waiting for a short squeeze. Well, what happens then?
Third reason, and I'm going to call this the final reason, right? Third reason we could be seeing some elevated prices is because estimated short interest, guys, record highs right now. 21%, roughly, right? I'm averaging right now. 21% estimated short interest for a 107 million shares short on AMC. It has never been this high, and therefore could lead to an even bigger squeeze than before. And the prices are primed and ready for people to jump in. So all of this combined is most...
Okay, now I'm trying to understand what he's saying here. The third and final reason that the price popped up yesterday, or the last few days, because the short interest is high, the record high short interest. Okay. So more short interest means that there are more shares that have been borrowed that are being sold and will be bought back at some point at a lower price level to realize the profit from the difference between where the shares were sold and where they were bought back. Now, I know you know that, but putting that in context of what he's saying, but short interest would seem to indicate that you have increased selling pressure on the stock. So this ORTEX screenshot is from yesterday morning, I think around 10 o'clock yesterday morning. There were only, 329,000 shares that had been borrowed at that point. So that was, like 10, quarter after 10 maybe. But what I want to point out here is that at this point you had 300,000 shares. Let's just call it 300,000. You had 300,000 shares borrowed, but you had 117,000 shares returned. And this is something that I've harped on a lot. People get tired of me talking about it, but it's really important because it is the other half of the short selling thing, and that is the returned shares. Now, I couldn't find an ORTEX update from later in the day, so I'm not sure how the stuff ended up. I guess I could probably go look at Short the VIX. He probably has one. But what we would want to look at is returned shares and the borrowed shares and the borrowed change. We want to see that and utilization. Now, Clay's talking about short interest being at an elevated level. Okay, so you had the price actually go up then. So let me put the volume on. Now, these volume candles here, this is TradingView's terrible volume. I have to go back to Active Trader here for this. Okay, so here we are at the same point. So in a 5-minute period, you had as much as 4.5 million shares traded, and the green indicates that there's more buying than selling. You could break this down even into 1-minute candles and look at that throughout this period here. My point is, though, these areas right here where you have the spurts of buying, what is that? Who is that? Let me go back to 5 minutes. In a 5-minute period here, you're talking about millions of shares being traded. Now, we don't have the ORTEX information, so I can't say for sure, but this smells a lot like short covering to me. Smells a lot like short covering. And what does the red stuff smell like? It smells like short selling. So December 6th, which was a couple Mondays ago, saw this area, this pretty large move, several dollars, and then, oh look, it popped right back down right after it. And you see that a lot. You see short covering when the price gets to a certain level, and then short selling immediately follow it, or vice versa. And you see that quite a bit. So, all right, here it happened again on a longer term time frame. Now, this one was last Thursday, I believe. Last Wednesday here. Again, you have a lot of volume, pretty big moves. Now, Thursday and Friday of last week, you have more short selling happening. And perhaps there were broader economic or market reasons, but we know, or at least we're told every day, that the apes aren't selling. So if you see selling pressure like this, do you think it was all retail? I doubt it. Especially something like this. The second 15-minute candle of last Friday, a week ago from this past Friday. Those types of moves. So now we're on to this week. Here's this Monday. Think that was apes? Think that was retail? Think it was institutions? What happened to the short interest on Monday? What happened to the short interest all week? Now, Tuesday, you hit this low, this localized low. This is where we actually saw AMC stock go down to $20.27. And what immediately happened once it hit that? It popped back up. So this would have been an excellent opportunity for some shorts to cover their positions, close their positions, take profit. It's the lowest point that this stock has been at since the stuff we looked at before, earlier in the video, back here in May. Right? It did not get that low. So why wouldn't there be short covering? And the answer is there absolutely would. And again, I can't prove it because I don't have the data in front of me. I don't have ORTEX. Common sense and experience say that that's where you cover. That's where some of these positions that came in $10, $20, $30 higher, potentially, you're gonna realize $20, $30 profit on each share. This is a 78% retracement of the run-up level. That might be a pretty good place to think about covering a short position, because what happened every time it hit the 61% retracement level? Popped up green. So you have to kind of think like an institutional investor a little bit and realize that it's not about apes versus hedgies and all that kind of stuff. That's all narrative BS. It's just about profit, at least for some people. Now, short positions inherently are a shorter term type of investment. You're not going to short and hold a stock the way that you would buy and hold in a long position, because among other reasons, you are paying money to borrow the shares. So the name of the game is to get the profit as quickly as possible, as much profit as quickly as possible, close that position. And if you want to open another position, well, then you can go ahead and do that. But you don't want these things hanging out there forever, because unlike a long position, you are paying to have the privilege of selling that share. Now let me say this, though. There is an opportunity cost involved in buying and holding long shares. So the notion that it doesn't cost you anything to hold, I think that's false. I think that there is. Now, there's a point where the curve of holding for maximum profit versus, versus opportunity cost getting too high. What else could you be doing with that money? You're waiting forever for this other thing to profit. It may not ever go up where you want it to. You could be using that money for something else. There's a point where those two lines intersect. No formula. I think it would likely be more of a feel or intuitive type of thing where you want to sell, get rid of that position, and take whatever profit you can, or maybe average the position down or something so that you can free up some capital. Because at some point, if your money is just sitting there stagnant, that's also making you lose money because you could be using that money for something else that could be making you money. So anyway, think about short covering, when it makes sense for shorts to be covering, what the effect is on the price action. And I guess when we see some ORTEX data, at whenever that is, then we can see if I'm right or wrong. But also remember that that stuff's not immediate, especially if shares are returned after they've been short sold and bought to close or covered. That's not going to register in the system for 2 days because of T+2. And a lot of people are forgetting about that. A lot of people are thinking that this stuff is instant. I'm seeing that all over the place on Twitter. People are talking about, well, there's this discrepancy. Why ORTEX is lying? There's a discrepancy between the utilization and shares on loan. And it's like, well, those things aren't instant. But in the event that return shares were not shorted, well, there was no market transaction, so there's no T+2. Those will be reported in returned shares, and I believe that utilization would go down immediately as well on that as well. But don't quote me on that. But I do know that shorted shares being returned do have to go through the settlement process. So, you know, there's a lot of mechanics that, even though the apes think that they know everything about this, there's a lot of major fundamental things that are always overlooked. I think chief of which is return shares. Return shares represent closed or covered short positions. I'll say it again. Return shares represent closed short positions. I mean, don't argue with me on that. That's what is happening there. Anyway.
What's generating the excitement and generating the increase in price, not just one of them. But if I had to place it in order, I would probably say, you know, buying the dip, being at $20 per share, was viewed as very low. The short interest, and then the increasing revenue for AMC with the excitement and hype surrounding Spider-Man. With all three of these things combined, could this lead to the short squeeze? I know that's what everybody, and that's what trickles in the excitement a little bit. Everybody's, oh, could this lead to it? Could this finally be? Could it? And then the excitement grows. Yes, it could. Is this likely the short squeeze?
Okay, let me just go back to the chart here real quick. So he thinks that this is buying the dip. He thinks that most of this action from Friday is buying the dip. I would completely disagree with that. It's not mostly dip buying, especially, I don't think, right at 9:30, 9:45. I mean, this pretty much happened right. And don't forget, it was also like the quad witching. You had options expiring. You had monthly options. You had quarterly. Here's a classic thing that happened. The max pain on the AMC options was, let's see, it was reported as 30. I thought it was kind of cool that AMC popped over 30 briefly and then vibrated around it and ended up closing below 30. So go figure. But there was also, and I'm glad I left this up here actually, there was also almost 100,000 145 strike call options that were open interest going into yesterday. And I looked at the time and sales for 145s. There were a few hundred of them that were bought yesterday, even up through 3:30 in the afternoon. Now, I don't know why anybody would do that unless they have no idea what they're doing, because you're buying an option that expires on the same day. You're buying it at 3 o'clock, 3:30 on that day of expiration. When you buy it, you bought it for $1. In the afternoon, when the stock was below 30, they bought $100 worth of 145 calls at $1 a piece. But the thing is, the bid price was already zero, so you couldn't sell them. The price would have to go way above 145 at that point for you to even break even on those things. Buying those deep out of the money call options is a waste of money, especially as it gets closer to the expiration. And it's clear it's not going to be anywhere near that. I mean, that's like 6 or 7 or 8 times higher than what the stock was trading at. So dumb, not very Not very smart. If people had saved their money and bought closer to the money call options, you could have forced gamma. You could have forced gamma because, I mean, that's almost 100,000 contracts. The highest over here was not even 30,000. So less than a third of the amount of these 145s actually meant anything. These 145s meant nothing. They meant absolutely nothing. Now, but if you had 75,000, if you had had 50,000 on several strikes around the money, now that could be different. It could have been different. And I talked about that at length before. So I know I'm rambling. It's a long video. Sorry.
No. Okay, I don't see the shorts covering. The estimated short interest is not going down.
Oh, wait a minute. Now, wait a minute.
Could it, and then the excitement grows. Yes, it could. Is this likely the short squeeze? No. Okay, I don't see the shorts covering. The estimated short interest is not going down, even though we had 100 million.
Well, shorts cover all the time. Okay, and that doesn't mean there's going to be a short squeeze. Like, shorts are covering every day on all kinds of securities, and these people have no clue. You know, they don't know. They have no clue because they think they've been conditioned by these YouTube charlatans to think, oh, when the shorts cover, it's going to be a massive, insane spike. Well, no, because who knows how many people are short selling this stock, any stock. Some of them are covering all the time. That's the reality of it. The big lie, like the January 6th big lie, like that Trump actually won, the version of that big lie for the apes is that the shorts will cover at once, or they will be forced to cover at once. That will never happen. It would never happen, especially since you've already had hedge funds lose their asses back in June and back in January on GameStop. A short squeeze is only going to happen if Wall Street is not able to prevent it. And how could they prevent it from happening? Well, cycle their short positions in and out. That's what they're doing. That's obviously what's happening here. They're not holding the same short positions for months and months and months and months and months, even when the price drops. And if you think that there is a short position that's currently on still where it was initiated at $10, you have no business being in the stock market. If you are that ignorant, then you think that people who manage and invest money professionally are going to sit there while that thing goes up to 72 and just, oh, well, it'll probably go back down to $8 and not do anything. You're crazy. You are crazy, and you should not be. Go trade crypto or something, but you should not be trading a stock, or certainly not options. The shorts would never cover all at once. That's the big lie. That's the big lie. Something like this already happened. And last thing I'm going to say about this is the apes are not tactful at all. They expect there to be a short squeeze. It's all over Reddit. It's all over Twitter. It's all over YouTube. It's all over every social media. Everybody knows the apes expect there to be a massive short squeeze. Do you not think that Wall Street, hedge funds, institutional investors are going to do anything that they can to make sure that that doesn't happen? Not because they don't want the apes to win, but because they don't want to lose money, and they will limit their risk. So many misunderstandings. You know, I'm only one person, but I'm happy that I'm seeing more people start to speak out on Twitter, at least. I'm seeing a lot of resistance start to build on Twitter, which is good. It's good. It's very good. Got to question these guys. You have to question them. You have to challenge them. And they're just going to say, oh, shorts haven't covered. And they have no justification. They have no actual evidence for anything. Apes, shorts have been covering the whole damn time. You have been played if you think that shorts haven't been covering. All right.
Shares being traded today, estimated short interest not going down. The price is going up, yes. But we need to remember, for the AMC stock short squeeze, we need the hedge funds to cover their shares. Now, knowing that, what could this lead to? This 50% weekly increase in the price of AMC could lead to more retail traders and swing traders jumping on. And as they jump on, the stock price rises. As the stock price starts to break these levels of resistance, more people will jump on. It's going to catch the attention of the media. Once again, it's going to catch the attention of all of these so-called apes that had fallen off since June. It's going to catch the attention of the world once more. And as these stock prices rise, as the fundamentals continue to rise, and as the short interest continues to rise, and more people start to buy AMC, it's going to cause that chain reaction that just drives the price higher and then eventually causes so much risk for the hedge funds. This is where the short squeeze starts. When the hedge funds that are shorting AMC have so much risk put onto them that they can no longer afford to keep their short positions open, and they decide to close them, or they are forced to close them.
Okay, he's not wrong there, but that's just not going to happen. I talked about that a few minutes ago. It's not going to happen. He's being disingenuous with that.
Now, I want to see them being forced to close them, but I will settle for them deciding to close them. Because,
well, you should be out of this then. You should not be making a video saying this. I hope his wife doesn't mind bald, man. He's probably in his late 20s, maybe mid 20s. He's going to be bald by the time he's 40.
Being closed. And that's what begins the short squeeze. And it's just imperative that everybody out there remembers why you got into AMC in the first place. That everybody out there remembers what your life-changing numbers are for AMC. Because, sure, $70 might look really good right now. You might be saying, $70, I'm out. Couldn't bust it last time, won't bust it this time. Well, they can if everybody holds. Keyword being everybody, right? Nobody knows.
This is just all speculative. There's no evidence for this. This is like the preacher standing up there saying, you know, what heaven's going to be like. You know, you're going to see those pearly gates and, you know, this and that, and you're going to see your great-grandma and, you know, Ray Charles and whoever else and Jeffrey Epstein, whatever. Well, nobody knows that. Nobody knows that. And most likely, it's not true. It's a myth. It was never substantiated. And stories like that, narratives like that, are created to serve some purpose. Somebody like Clay, it's pretty clear to me, at least, why he would continue to push this narrative. Now, at one point in the past, there might have been a time when some of these things were more realistic. However, given what we know now and what has played out over the last 6 months, for the same narrative to be pushed, you know, like nothing has changed, that is quite disingenuous. I'm not saying the stock's not going to go up and down. It's going to go up and down because there are shares being bought and sold. What I'm saying is the narrative from May, June, July that has not played out, that's not happening. That's what's unlikely to happen. Not saying that you can't make money. I traded calls and puts yesterday on AMC, and I made money on both. So the potential to make money is more than there. You don't need a Moass. You don't need a short squeeze. I'm going to let him finish.
That's what everybody's going to do. But you need to remember that holding as the price is rising is what causes them to offer higher and higher and higher prices. If we just give it to them for 60, 70 bucks a share.
I really don't like that explanation. Like they have to offer us, the price. And if we don't take the, they're going to offer us more. I mean, that's not really a good conceptualization of how the market works. If it's fundamentally overvalued, it's not going to really reflect that. That's not what happened in the short squeeze or the gamma squeeze or whatever the hell the run-up was. It's not why that happened. Not why that happened at all. So, because plenty of people sold, I mean, plenty of people bought too, but that's psychology. It's FOMO. The option chains are just so fucked up anymore that type of run-up will not happen, I don't think. Unless they got rid of any strike price above 50, they'd have to stop the strikes at 50. And that might not even work because these options are so overpriced, usually because of implied volatility and just because of the demand. There's so much risk premium in those options that, a lot of the apes wouldn't be able to afford them or they wouldn't buy them. Or if they would lose money. So I don't know, Clay. Let me finish.
Short squeeze is over. But if we don't give it to them, and the shorts are covering, they have to offer those higher prices. So guys, I'm excited. Take this excitement into the weekend, take it into next week, and let's watch AMC gain
All right, that's all. So, yeah, I mean, like I said, that's really a misunderstanding of the market because the market is the middleman between buyers and sellers. So they buy from sellers and they sell to buyers. So you can either choose to buy at the price that they're selling at, or you can choose to sell at the price that they're going to buy it at. But if there's a mismatch there in what people want, there will be no deal. That's really the outcome. It's not like they're going to have to offer you more. No, they just You just won't be able to sell it. You will just be stuck with a worthless asset, ultimately. So, anyway, thanks for watching. I'm going to wrap this up. Sorry about the long video. I do appreciate the support. Check out my finance chat on Telegram. I got the link to that in the description for this video. Also the link to the Claybro video that we just watched. I try to put links in my description that are relevant or things that I looked at or used. But if there's ever anything that I don't put in the description that you are curious about, feel free to shoot me a comment. Come in finance chat, ask me, say, hey, Scott, where was that? Blah, blah, blah. I'd be happy to do it. I'm not hiding anything. I'm obviously not monetized because I only have a few subscribers at this point. Hopefully that will grow. Somebody insinuated that I was a paid shill, like being paid by the hedge funds to put out content. And they did that before too. Nope, I'm not any type of professional in finance. I'm not being paid by anybody to do this. I'm doing it in my spare time on the weekend after work. You know, when I have time to do it for my own enjoyment and to try to just, you know, correct the record, fact check these guys. I don't like seeing people lie. I don't like seeing people misled. I don't like seeing people lose their money. Now, if Trey, Short the VIX, Matt Kors, Wrench Capital, if all those guys, Finance News, that other Clay from Finance News, Matt Stoner, if they all lost all their money, that wouldn't bother me. That wouldn't bother me. That would be like poetic justice or something. It would be fair because they have dispensed such terrible advice that people did buy at $60, $70 because they were told and they didn't know anything about the market. Rank and file members of the public who became apes, they didn't know what was going on. They trusted these people and the information that they told them, a lot of which turned out to be false, wrong, incorrect, fraudulent. And they all made out fine. Trey has enough money to go around and hand out $10,000 tips. And likewise, it's irresponsible for this dude to say the shit that he says. There's no evidence. Show me some evidence. You know, we looked at a chart. I looked at resources, facts, evidence, data. This guy's just sitting here talking. He's just sitting here talking. Take it for what it's worth. But the resources are there. You can take a look at it too and come to your own decision. But just remember this. You're hoping for a get-rich-quick, which will never happen. You cannot count on that. So you have to take measured profits, 10, 15, 20% profit targets. Take it, move on to the next thing. You are never going to make all of your wealth in one play. The notion that you could, should, or even can is false. It is wrong. That's not how it works. Anybody will tell you that. Anybody will tell you that. Unless they are an AMC YouTuber, then they will say, no, you should put all your money in AMC. Well, unless you want to lose 100% of your money, or damn near close to it, diversity is the name of the game. Learn from your mistakes is the name of the game. Move on to the next thing. Quit spinning your tires into the mud when you could be over on the road, moving forward. Thanks for watching. Leave a comment. Check out my Telegram finance chat. Enjoy your Saturday. Catch you in the next one. See ya.